Welcome back, everyone, to the Mortgage Heroes Weekly Podcast. I'm Andy.
And I'm Brian.
I'm Will.
So today, guys, on deck, we have 4 topics. We're first going to talk about mortgage delinquency. Then we're going to talk about high opportunity neighborhoods. Then the consumer's souring outlook on housing. And then data points about where housing may be going this fall. We're going to jump right in first. Let's talk about mortgage delinquency rate falling to its lowest level since 1979.
That is unbelievable.
That's really good on one hand. And obviously, I think there's some obvious reasons why that's happening. I would say that low rates is obviously a catalyst from 2020 and 21 and 2022. I think that's contributing to it. Obviously, affordability has not been in our favor. We've talked about that on recent shows too. But I mean, this metric's going back now. How many years? 44 years almost now. I'm not surprised by it, but I am surprised by it because everything else seems to be expensive, and I think financial pressures mounting on people will eventually cause delinquencies. But right now, I guess we're not seeing them.
I guess I'll ask, for how long are we going to see this?
That's a great question.
For how long right now? And I think that's everything that's coming out right now, we're still seeing it in these past reports. I mean, consumers are still spending. That hasn't gone down. And until that starts to come down, then I feel that people will start feeling it. Yeah. I remember you mentioned something that when people start, really feeling the financial pinch, the last thing that they stop paying is their house. We're already starting to see credit cards go up, car payments as well, missed payments, and the last big one, of course, we know is your mortgage. So that's why I asked for how long until we start seeing that number go up.
Here's the thing, guys. We got to remember that when it comes to the government, the numbers are always going to be fluffed up a little bit. Just like unemployment, right? You're not considered unemployed if you're receiving a check. So now what's happening is, if we're seeing these delinquencies, what's happening is one thing that we've learned in 2020 when COVID happened. We got to see a lot of loans get modified because you were in forbearance. And so when that term of first started with 6 months, we went to 12 months. Then they did extended another 6 months. And then I got extended. I was hearing some people like 24 months without making a mortgage payment. And then all of a sudden, voila, your mortgage is now converted all into one. So whatever you were in forbearance, let's just put it all together in one, and let's reduce your interest rate.
So what you're saying is it's kind of both and. It's a function of the low rate environment that we had where people did refinance into, and it's also a function of having forbearance.
Yes. So what we learned right now in 2020 is that now we're able to do loan modifications. And that was something that wasn't existent in the mortgage meltdown. That's something that was a new thing. Well, in 2020, it sounded like we were already really good at this.
I feel like they're like, hey, we've already gone through something like this before. Yeah. I think there's something smart that we can do here.
Exactly. So right now, a delinquency is not going to count because it's under that loan modification right now.
Yeah. Because it actually isn't delinquent, but it's the function of that being
That's
changed.
Correct.
Yeah.
But we're seeing a lot of people that cannot make their mortgage payments right now, but because they're going through some type of loan modification, it's not considered delinquent.
Yeah, and it's not delinquent yet.
Yet.
So the tie-in,
that's actually really good insights.
I think the tie-in here is part of the same article was talking about despite the encouraging news, the Mortgage Bankers Association reported signs of consumer-related stress with delinquencies rising for other forms of credit, including credit cards and car loans. Ding, ding, ding. Guess what? Which are connected to the
federal funds rate.
Was that multiple choice?
So immense.
No, it was the right answer. How to go for it. To go wild guess. Thank you, everybody. Appreciate it.
So what we've seen is there's been immense pressure since March of 2022 when the Fed started ticking up rates that now is spilling over into these consumer car loans and credit cards where they are directly affected. And there are going to be slowdowns in that. And you're mentioning there's delinquencies in that. And I think that is something we're going to see for the foreseeable future until you can either correct that with new income, more money, a second income, third income, side hustle, or some sort of modification or some sort of forgiveness. And I'm not sure that we're going to see forgiveness. I'm seeing repossessions in cars and that kind of thing. But I will tell you, side topic, a friend of mine who is a bankruptcy attorney has recently seen an uptick of bankruptcy interest and cases because of these kinds of things, rising consumer debt, medical bills, collections, things like that. So this is something I think we should watch.
Yeah. Okay. Well, there's also a reason why the government decided to say, hey, student loans no longer can reflect 30-day lates, right? And no longer have to be paid. It's like just doesn't reflect on your credit report. And if it's there, you can remove it.
What?
Yeah.
So
it's anything that just passed.
How do I get that off my client so I get approval from one?
Well, yeah, that's the thing, right?
we might
I
have
was
to
going to
do
say,
a-
you got no student loans. You didn't go to school.
I didn't go to school. Thing. I was just thankfully, but yeah, no, in a sense, you know.
Yeah.
We'll have to do a whole credit show at some point.
Yeah, that medical collections too. You know, I know it's a separate thing, but it's still kind of along this. You know, you're getting your home modified. You're getting student loans, kind of.
I didn't
Because
know
the
that
government understands that we're going through some difficult times.
Yeah.
Right? They understand that. So how do we kind of still make it where it's not as bad?
And I think it directly has a lot to do with the policy change you're trying to make effect, trying to affect, and not knowing how that ball's gonna land.
That's right.
So
that's literally it.
Yeah. I think a lot of uncertainty is what's driving that right now, but we'll see in the future if that actually gets settled or not. Let's move on. Let's go to it's harder than ever for low-income families to buy in high-opportunity neighborhoods. So there's some subjectivity in this. There's some math and some evidence in this. Of course, there's fact, but there's also some opinion, in my opinion.
Same.
And so let's first talk really quickly about how they broke this up. They broke this survey into 100 of the most populous U.S. metropolitan areas, and sorting each neighborhood into one of three tiers: low opportunity, intermediate opportunity, and high opportunity. Go. What are some of your takeaways, guys?
So essentially what they're saying is that in areas where you have a higher chance of being successful, getting a better education, there is a lot less affordability, which is very true. I mean, we live in we live in the eastern part of Chula Vista, a very desirable area. And I mean, you see the home prices here, very high. Even from the earlier years, it was always a desirable area. So, I mean, only over time, things get more expensive that we've seen. So I think, you know, people knowing this information, is going to let them know exactly what they need to do to put themselves in the right environment. And then I also listened to something, you know, might be a little bit off topic from this, but it was like when you put a shark in a tank and the tank is small, he's only going to be able to grow as big as that tank is. But if you put him in an environment where he's free to grow, free to move around, and have a lot more space to basically, you know, grow, then it's going to have a better impact on his, you know, growth, on his overall just trajectory of life. So I feel that has a big comparison to how we do things in the microscope here in cities, in states, and in countries, where you can go up the street to a certain area here in San Diego that is not going to be as fortunate as if you go to like a La Jolla, Oceanside, right? So there's a whole bunch of different mix of, you know, those types of areas. And I feel that having the information of this to let you know how that works out, it lets people know that there's other opportunities that they can work towards to be able to escape their current situation. Because I don't feel that you have to stay where you're at. It's more about finding the right tools and information to get out of your situation.
Yeah.
And one thing I want to point out about this article is that, you know, they're citing in this study that only 13% of the homes in the high opportunity neighborhoods are affordable. So, I mean, that's a huge disparity. That means 87% are unaffordable, right? And then that's down from 37% a decade ago. So like, look at that change. So you go from 37% down to 13% in just a span of 10 years, let's say. And actually, this actually goes pretty closely with another study. It was unrelated to this article, but I saw another study that came out that said only 16% of Californians can afford a home to qualify in California.
Yeah.
And that it now averages $208,000 of household income in order to qualify. So I know that this was this was 100 most populous metros in the country, but California is kind of a microcosm of this too. If only 16% of our population can afford.
Yeah, no, it's totally. As a matter of fact, like yesterday, Mikey, the youngest mortgage hero, right, and I were actually looking at a file, and we have buyers that were well prepared.
Yeah.
Hardly had any debt. Their debt was so low. They had great credit scores. They were in the 780s, but yet they couldn't qualify for anything. The max I can qualify them for was $395. You know, husband makes it was like $58,000. Wife make another $33,000. When their rates were like 3.875, they can go up to like 5 and change.
Yeah.
Right now, $395. That's it. There. So they needed, and at least to go to 580 with the 300 HOA, they needed to make at least $140,000. Well, how do we get that person to make more money?
Wow.
Right? How do we get that? Like, it's the average income in San Diego is $69,000.
And that's what I was going to say. From when it was 37%, now to 13%, how much has income and salaries risen?
Not much.
Risen since then. Barely.
That's one of the things we don't see.
Yeah. That's unfortunate.
And those are facts.
But that goes with this. And I mean, again, the survey broke this up into low, intermediate, and high opportunity. But I think the fact that the high opportunity is just so inaccessible, it's going to be a problem. It is a problem already. It's going to continue to be a future problem unless we can cure this somehow, or make those intermediate areas, bring them up to the standard that the definition of a high opportunity is considered. And of course, that would even skew the numbers too, because you're changing how you're judging or defining these three categories. But again, back to affordability issue, like, it's crazy. Our next topic's going to dip into this too, because I think it's now causing some consumer sentiment to sour. Because it is becoming more challenging for people that are probably working very hard, and maybe they both need to get a second job, or maybe they're not in control of their hours at their primary job and they're not making enough. Like, there's other constraints, there's other variables other than just the number on the paper that allow people to work more or less, or not be able to have a second job. So this is definitely a problem.
It really is. I'm telling you this. And they're talking about millennials staying at home longer. The average age for a person to live their home is 36 years old.
Jesus Christ.
That's gone up. And these are things that we're saying earlier, that millennials aren't buying us homes. Well, we understand why.
They're waiting for parents to inherit.
There you go. I remember back in the day, Andy, we used to say, okay, $24,000 to $30,000 of your income is going to go towards paying a mortgage. Well, if your average payment is 55 to 65,
you're paying your whole
$100 a month. It's crazy. It's crazy.
Well, let's jump ahead, guys. We're going to go to now how this kind of dovetails into the next thing, which is a record 82% of consumers reported that it's a bad time to buy a home. So this is a survey from Fannie Mae's Home Purchase Sentiment Index, which is short the HPSI, and essentially it's signaling greater pessimism that people have in general at large towards buying a home and the conditions for which it takes to buy a home.
I mean, we're having home prices are way higher than before. So that doesn't make it any easier. And so therefore, you're going to be skeptical and say, well, how much more can homes go up, in value? They're just not going to go. Then you have our mortgage rates. We continue to have such a great time with that. It just keeps the market
risen.
So 82% of consumers reported that it's a bad time to buy, which is a new survey high. So that's already bad. Hey, we're number one for the wrong reason. And it's up from 78% in June, which was just, a month prior to when these results came out. So it's already it's highest, and now it's going in the wrong direction. And I want to read this from Doug Duncan. Doug Duncan, Fannie Mae Senior Vice President and Chief Economist. Doug Duncan, Fannie Mae's Senior Vice President and Chief Economist, says, while consumers are reporting confidence in the components related to their personal financial situations, it's unlikely we'll see housing sentiment catch up to other broader economic confidence measures until there is meaningful improvement to home purchase affordability. That is quite the admission, especially given the fact that he's his Senior VP and the Chief Economist for Fannie Mae.
Well, there it is. I think that's it. We're done. He said it all.
Well, and then he followed up with this. Unsurprisingly, consumers continue to attribute the challenging conditions to high home prices and unfavorable mortgage rates. Further, the share of consumers expecting home prices to continue to rise has also been on a steady climb since March, which may only add to perceptions of unaffordability. What do we do, guys?
And I mean, I'm hearing it. I mean, a lot of people they want to get in the market, they want to buy a house, but then when they see the payment at a condo that they're buying for $500,000 with a 350 HOA, and they're close to $4,500 to $5,000, they're like, well, wait a minute. That's like a whole yearly salary I'm paying right here. And then on top of that, I still have cost of living. It really makes them double think whether it's something that they want to do or not at the present moment. And I feel that's where it comes down to, where it's, you really have to have that plan and have that responsibility that if you want to take this payment on, you better have an exit strategy or really good, plan of how you're going to be able to, weather these waters. But there's opportunities in any market.
Of course. I mean, you got the mortgage payment is 45, but then you're also paying 36 for a 2-bedroom. So you're kind of like, it's a catch-22.
And then next year it goes up a little bit. So it's like, how much more until it makes more sense to be able to purchase and then pay the difference?
It's kind of like getting your solar, right? Do I lock in my energy bill now for the next years, and it only goes up like 2 some percent, my solar, kind of like taxes go up a little bit. So your payment gradually goes up a little bit. With your homeowner's insurance will also go up a little bit. That's the only thing, but the rate and all that, it's going to be a 30-year fix. So that doesn't have much bearing on the payment going higher. So you're pretty much set with that. When you're renting, Obviously, we already know they can rent. The landlord can increase your rent by 5 to 10%.
And
more
they do.
Yeah.
every year,
And they do.
So that's why it's like almost similar to solar. Do you lock your payment now? Or do you risk the chance?
I'm gonna make a statement. So if we're saying that consumers are saying that things aren't gonna get better, what do they think that's gonna happen with homeowners that are that rent out their houses to other people? Do you think they're gonna just be like, oh, it's cool, I locked my payment in? No, they're gonna try to raise their prices as well because everything's going up. So then again, it goes down to, are you okay paying down someone else's mortgage and helping them build a long-term financial stability, or do you want to do that for yourself and your family? That although maybe right now it might be a little bit of a sacrifice, but down the line 10, 15 years, even 5, you'll be in a way better position or a different position than what it was today because you took that step. And it was actually, I admire a client I met this past weekend where he purchased in 1999, only made a refinance in 2004, and has held his property, a duplex in a single house, since then. So he's full of equity and he's ready to basically take advantage of it. And he's like, I've just been paying my mortgage every year, doing what I got to do. I show up to work, I pay down my mortgage, my duplex is getting paid down. He's like, I just know that it's time for me to basically take my investment. And he wants to go to Oceanside, Carlsbad, and North County. So I'm like, you can with this,
Yeah.
And I told him, I wish that a lot of people took that sacrifice at a young time, buy, hold, because look at now you're going to be able to transfer this over to your family, your kids.
You said the key word right there is sacrifice.
Yeah.
Everything that we do in life comes with the sacrifice. So you got to start making the decision now. And it's just, you take action now or just wait for later, and that's it. So
100%.
So 64% of the respondents of this survey believed it was a good time to sell, while 36% said it was a bad time to sell, which is interesting because, first of all, I wish that 64% that believe it's a good time to sell would translate into inventory, which clearly is not happening, right? So a little observation there from good old Andy. But also, I think that's the separation of the idea of it being a good time to sell versus the reality of wanting to sell.
Yeah.
Because of what we talked about before. If you're a seller right now, the second that deal closes, you're a buyer tomorrow.
That's it.
And then people are hesitant to be a buyer on this side when they're sitting on a sweet deal right now.
So I think that 36% is people that don't have that much equity in their house.
It could be for a variety of reasons.
It goes back. If you have that equity, you can basically go buy another house. If you transfer your equity over, your payment's going to basically come as low as possible, so you don't have to basically go towards the high payment, the high rate. I mean, you'll still have the high rate, but thankfully, because you have that equity from your other property, if you structure it correctly, use some of those funds to make your loan make sense, bring down your rate, you can have that payment that you want.
Again, the best cliche has been, don't marry the rate, marry the home.
Marry the home, date the rate.
Well, I want to.
They come and go. They come and go.
I want to close with this final thought for this article, which is, there's a group that they have, which is called the Economic and Strategic Research Group, a part of Fannie Mae, that expects overall home sales in 2023 to remain near the lowest annual level since 2009. And that caught my attention because 2009 was not a banner year for real estate. So if we needed another warning shot across the bow of what's ahead for the fall and the winter, and maybe the beginning of 2024 for real estate, I think it is that. Prepare for very little inventory.
I was just getting into high school in 2009.
Yeah.
2009.
Okay, next topic.
Yeah, no, I mean, hey, this is crazy. So do you guys know what the median sales price in San Diego's been?
Is it what it is 2023? It's like $809,000, something like that.
809. Take a guess. Higher.
$999.
$890.
Okay. Oh, $890. $890. I had them in the wrong pace. Okay.
Yeah,
$809. You're dyslexic.
Guys, that's pretty crazy.
That is.
And here I was. I just thought I was colorblind.
Yeah. Do you guys know
You're
the most
too.
Do you guys know where the most expensive area is at?
In San Diego?
Uh-huh.
I would say Rancho Santa Fe.
Okay, good.
Mount
Good
Carmel?
guess. Pretty close. No, La Jolla.
La Jolla.
Yeah. Average is
The Jewel.
2.8. Yeah.
Oh, average. Oh, okay. All right.
The average is
makes
2.8
sense.
right there. It's. I'm just thinking like Rancho Santa Fe. They're probably not selling either right now.
I don't know. Yeah, I mean, there's going to be inventory, paltry inventory across the board. So
Exactly.
Okay, well, that kind of dovetails us and weaves us nicely to our final topic today, which is data points data points to cooling in the housing market this fall. Mortgage rates have been above 7% for a couple months, and I know we have ebbs and flows where certain days it kind of dips below for a minute, but it pops its head back up. We got problems on the 10-year yield because of bond pressure and basically central bank issues that are global.
Global.
So it looks like available inventory is going to start slowing because on the chart that I gave you guys, the only year in the last 6 years that there was less inventory that there is now was in 2021.
Yeah.
Whoa.
And 2021, of course, is when everyone's thawing out from being on lockdown and working from home and life changing for everybody. And so every other year since 2017, there's been more inventory than there is right now. So we are at the gutter of inventory when it comes to the last 6 years, with the exception of 2021. And I think that spells trouble for people being able to get into homes. But I think that does signal that home prices are going to be healthy, and that home equity we talked about in previous shows will continue to stay intact.
Yeah, and I tell you, relationships are so important right
100%.
now. You know, who you tie your raft to right now is going to be very crucial and important.
I think for this, what I was noticing right here is that every time since 2017, around September and October, it starts to come down. And I noticed it right here. It starts going on a downtrend, and into October is where we start seeing the least inventory, except for 2022, where it spiked up a little, only to come down at the end of the year. Now, I don't know if that's going to be the same case this year, just because we've been seeing inventory even lower than last year. So I expect that to start sharply dropping down as we head into September and October, because I mean the data doesn't lie.
Yeah. I wrote a little note here. I said the fall starts in the fall.
Yeah.
The fall of that curve that you're pointing out there, Brian, kind of around that August, September, October mark is where it does start, curbing a little bit, less inventory. And here's what's funny about that is I know from all the years of doing real estate that there's actually really good sales that happen during the month of November and December.
Oh, yeah.
Because people are walking into homes that are listed for sale and envisioning the home in its like celebratory environment where people are
Christmas
having Thanksgiving,
lights.
they have Christmas, it's holiday season.
Yeah.
And so on one hand, you
yeah.
go, okay, if I'm a seller, gosh, I don't want to move during the holidays. But if I'm a buyer, you're walking into a setting and an environment that illustrates the kind of home environment you're hoping to have and why you would want to buy a house. So for sellers who are looking to sell in November or December, you're going to have a pretty good crack at it this year because there will be less inventory and you still have people in the market that are qualified that are looking for your home.
Yeah, and I feel a lot of people it's going to be a good time as well to be able to cash in at the last end of the year. I know a lot of people are going to need it. Yeah. So, hey, that's also another big motivator.
Yeah. Hey, buy your turkey now.
Yeah.
Freeze it. Yeah. Remember, we're running out of eggs here for a while, too. So you never know what's going to happen.
I actually started raising a turkey last year.
Oh, good.
Yeah. His name's Santi, and he's one.
And I actually already started for the one next year.
He's the cooker.
I also, in this same article, guys, saw that there's 10% fewer homes on the market now than there were in 2022. The new pending sales entering into the market is slowing down. Time on the market is super low. And you have price cuts happening. And price cuts happening, I would say, situationally and also seasonally. It does seem that there's a pattern for price cuts. I know that what's behind that is the situation or the circumstance that the family or the homeowners are facing. And it's not just price cuts for the sake of price cuts. It's not just market pressure or policy. It does have a little seasonality to it as well. And I think that we're going to see that. Even with the inventory that we have, I'm not talking steep price cuts of 10, 20%. I'm talking 2%, 2.5%. It is not a lot.
Yeah. All the data we used to get in the past years, like, all right, spring break's here. We're going to see more inventory. All of it's been false in 2023. Everything. I don't even know what to say anymore. What I thought I knew, I don't know. It's like, I'm confused.
Yeah, they used to be kind of like you just kind of trust that this type of year, this kind of thing happens. Yeah, and that's been changed. That is different. The things you would accept as norms during the spring and summer have not exactly panned out that way, which is I think it's caught my attention. It's made me a little bit more aware of what's going on and a little more data reliant too, and leaning on to, okay, what's it actually showing? And then go upstream. Where's this coming from? What are the reasons that it's happening this way? Why is this arriving at my desk in my inbox at this juncture? What's the original cause?
I think that's the question everybody should be asking, because you hear all this information all over the news. You'll see it on Facebook. You'll see it all over social media, but no one stops and asks, but why? Why is this happening? Why is that happening? Everybody's just like, oh no, it's because that's happening. Okay, we all know that, but why?
Yeah.
And that's where I feel, the root of everything is asking the right questions to get the right answers.
Yeah. It just seemed like before you would just need to have that information. It would be just right in front of you. Yeah. Right. Yeah. But nowadays it's such a global economic issue that everything gets affected. You know, it's like a little ripple when you throw that rock into the water and you see like a little ripple and it just starts spreading. That's how it seems to be right now. You have to be paying 100%. Attention to everything else that's not just going on here. You know, China, we got Russia doing its currency, Ukraine with their, like all these things are just like, I don't even know what to say. I just don't even watch the news.
No, that's not going to help you. But watching this show will help everyone who does. So
thank goodness Andy does all the research.
No. It's a collective effort, guys. So I want to end by asking a prediction, and we'll go back and we'll look and see what happens here. So I'm going to put the item on the table is home prices by the end of 2023. Will they be lower, the same, or higher than they are right now?
Higher.
August of 2023.
Higher.
Memo?
Higher.
Memo says they'll be higher. Brian?
I think we're going to be right around the same.
You're going to be the same?
Yeah.
I'm going to say that they are going to be the same.
Yeah.
So we'll go back and see. We'll actually come back to this video. We're going to comment on this in December, or actually probably in January once the December numbers are done. Let's see what happened to San Diego prices. One of us will be right, or all of us could be wrong because no one said low. So we might actually be wrong. We'll see. We'll see what happens.
Well, let's include Mikey. What do you think? Higher or lower?
To be honest, I think it's going to be lower because haven't we been hearing that they're expecting to keep raising rates throughout the rest of this year, possibly next year as well. So, I mean, eventually the market's got to correct itself and prices do have to come down. It's been quite some time that they've been rising. So I think, eventually towards the end of the year, we could see it go a little bit lower.
So
That's
one
good.
word.
Low, same, or high? Low. Mikey says lower. Off-camera Mikey. That's his new nickname. Off-camera Mikey. Off-camera Mikey says lower. So we're going to go lower for Mikey. Same for me and Brian. Higher
I'm going to go higher.
Memo.
Okay.
And then like we did last week, guys, I want to ask you, what was your favorite part of the show today?
My favorite part of the show. So I actually want to let you guys know in a little rule that I read here that I think might bring a really good insight to what's happening, right? It's called the Altos Rule. And essentially, higher mortgage rates equals higher inventory. Lower rates lead to lower inventory. Higher mortgage rates create greater holding costs for real estate. Therefore, fewer people hold real estate. And there are more sales and more inventory. Lower mortgage rates spur demand and hoarding of homes, so there is less to get. So what stood out for me from there is that it doesn't make sense because rates are high, prices are high, and we're all over the place. So that's why I expect prices to stay around the same, because if they spike rates too high, then they're really going to tank this. So they have to be very strategic in the way that they move for the rest of the year if we want to have a shot at, having some sort of real estate market in 2024.
Yeah. For me, it's just simple economics.
Yeah.
It's just simple economics, and that's why I'm saying it's going to go, price of homes are going to go higher, There's not a lot of inventory, but there's a lot of demand for it, and therefore, for me, that's what it is.
We'll see in January.
Yeah, my biggest takeaways, Ben, obviously, is going to be the average income that we continue to, have in San Diego. You really have to step it up. You really have to now maybe have 2 jobs, have 2 careers. I don't know but I'm starting to see more of that as a trend.
Yeah.
People having a full-time job with another full-time job, believe it or not. The main thing I've seen is full-time job with a
side hustle.
Yep.
That's it.
Yep.
That's
it. Yep.
Okay.
So my takeaway from today is a little bit more on the dour side, guys. I'm going to go back to the HPSI, the Home Purchase Sentiment Index,
okay.
And where their economic strategic research group is saying that they expect overall home sales in 2023 to remain at their lowest since 2009. Although they are for much different reasons, I do not like any reference to 2009 because of what happened right before 2009 and then how long it took to get out of 2009. Yeah. So I have great hesitation in that, but it is the thing that caught my attention the most out of all the articles we covered today. So again, thank you guys for being on the show. Thank you so much for being prepared and bringing your ideas, your opinions, and your feedback. And thank you all for watching the Mortgage Heroes Weekly Podcast. We're glad you watch us every single week. For those of you on YouTube,
thank you.
Remember to subscribe to the channel, turn on notifications, and if you're if you're listening on Apple or Google Podcasts, remember to follow the show and make sure you get every episode direct downloaded to your favorite device to listen on. Thank you for watching, and we'll see you again next week.
Thank you guys.
Have fun today.